So welcome, Malla sir. So we are back with our Jungly July challenge.
This month again we have three things. We'll talk about motivating us learning about taxes. We'll talk about a concept of alpha and beta in the market, and we'll follow up on our exercise from the previous months. We thought about what to do this month, and we decided to go with everyone's favorite topic, taxes. So, there's a famous saying that two things are certain in life, death and taxes. But essentially, we wanted to motivate that taxes is not something that should always just daunt people and make people feel a bit helpless and कि अरे ये तो देना ही देना है. Taxes is good in a way. It is useful for nation building. It is how we give back to society, but it is not a immutable thing. Like we should definitely work with the tax code, even though it is daunting, but with some parts, like layer it layer by layer, and try to understand why we are paying certain taxes, how much we are paying. Are there provisions that help us and can align with some of our financial goals, like education, retirement, to get us that extra tax savings, which will compound in the future?
My impression is like tax are kind of set. Like I get a salary that is tax deducted, like deducted. So, uh, what can I do to save tax?
So essentially, that is true. Like for the most part, for a basic setting where someone is drawing a salary and that is about it, the tax filing is also very simple. But as you start to branch out and you do more activities, financially speaking, like you are engaged in more passive investing or putting money in real estate or other kinds of accounts, there are certain tax rules that start to apply to you and can favor you. For example, if you have own a home and you're paying a mortgage on that home, you can deduct the mortgage interest, right? So these, as you start to uh, go beyond just earning a salary, which is the point, like we want to get over this state of only living off a salary and ideally get into a passive state where we are not actively working. So that will happen by understanding the tax code and working with it. As we are making various accounts, right, we should understand that every account works a certain way with the tax code. So certain accounts are advantages when it comes to the tax code, and certain accounts are disadvantage. So if we first talk about the regular account that most of us are familiar with, like a savings account, of course, the money that goes into that is already taxed because either we are getting it as an income, so the employer has already deducted certain tax from it, or we got it from some other bank interest and so on. So all the money in it is already taxed. And in fact, it is continually getting taxed as it is staying there because every dollar of interest earned on that account is always going to get taxed at the end of the year. So it's not because we are not paying that tax bill continuously day in and day out, we feel like it is not being taxed. But every moment that is in that account, it is being taxed. The only difference is we'll pay that tax bill only once a year. So that is important to note that tax disadvantaged accounts are continuously getting taxed. So ideally, you want all or most of your money in a tax deferred account. So that is the other category of account which which work well with the tax rules. And there, the idea is that the money either going in is not being taxed, for example, a 401k or a provident fund where the employer makes that account for you, or the money going out, like when you take the money out, you will not have to pay tax on it. I mean, if you think about, let's say you get $100 from your employer, right? Now you feel like, oh, I've already paid tax on this. But if you are able to put that $100 back into a tax advantaged account, you can actually claim the tax you paid on it, and that is your sort of immediate return.
So how can I like know more about the tax deferred accounts that apply to me?
Yeah, it will come again from the financial goals that we have. So let's say you're planning to buy a home, you should research uh, tax rules for home purchase. And so you'll find articles, and we can share common articles about that. But if you're, let's say, setting up an education fund for yourself or your children, you can research tax advantaged accounts for education. Um, since tax code is very broad and very laborious to understand, there is no single place to understand everything, but at least as a start, you can look into retirement and education.
Okay, sir. So let's move on to the concept. Like, what are alpha and beta in the markets?
Yes. So both these are two of many other metrics that one can calculate to understand the health of one's portfolio. So essentially, they indicate how well you are doing in some sense compared to the market or some sort of index or benchmark. Everything is compared against some sort of benchmark, and most popular benchmarks are indices like S&P 500 or Nifty 50 and so on. So talking about alpha, alpha is in some sense how your rate of return compared to the market. So your average rate of return of your portfolio compared to the market's rate of return. So if you imagine the that fable of the hare and the tortoise, it is essentially the speed. So in how fast are you able to compound money compared to the market? And similarly, beta is sort of that second degree of that, where you look at the volatilities. And what that tells us is, in some sense, how much risk are we taking relative to the market. So beta is usually it's a ratio that is between 0 and infinity. And if it is less than 1, that means you're less volatile than the market. And if it is greater than 1, it means you're more volatile than the market. And of course, and speed is between minus infinity to plus infinity. If it is greater than 0, that means you're doing better than the market. If it is less than 0, you're doing worse than the market. So ideally, what you want to be is have alpha greater than 0. That means you're doing better than the market in absolute return, and beta less than 1. That means you're able to do that by taking less risk. So that is what most hedge funds and all try to do, is they try to get the similar return characteristics of stock, and volatility characteristics of a bond, which is kind of very smooth and upward trajectory. I mean, one way we can compare this is, if in that parable of hare and tortoise, we know the story that over time tortoise was able to beat the hare even with a low speed, because it was able to do that consistently. And in some sense, the volatility of hare's speed was much higher than its actual speed. So that is why you always want to lower the volatility as well. It is not enough to just have a high speed, because you have to be able to do it consistently. So both these numbers need to kind of be in check. You also don't want very low alpha. You want it to be at certain level. So these two numbers, they may be anything, just like your savings rate. They may be at some number right now, and but they should not be ignored. You can look at them over months and try to see where they are trending, and then you can understand more about your present state and maybe seek a financial planner, or continue in building up your skill set for managing these numbers. Yeah. So for the third exercise, we'll basically implement some of these ideas in that same spreadsheet we have been maintaining. So, I mean, if we pull out again the spreadsheet that we uh, completed last month, you will make a new tab for this month, July. We will copy over the numbers from these accounts. Now we will copy over the numbers, net worth numbers from July into the main tab. You can get the uh, equivalent values of S&P 500 or whichever benchmark you would like as of May, June, and July, and you can calculate your alpha by this formula, looking at the difference of these two returns. And then you can use this particular formula to get the beta
given these two sequence of returns. So these two values will come out to be some numbers. And now going forward in the coming months, we'll be building out a sequence of alphas and betas for your portfolio. And we'll look at the trend where that goes. Ideally, the alpha should keep going up and beta should keep coming down.